Okay, in our previous videos, we looked at horizontal analysis. In this video, we'll take a look at vertical analysis. Okay, with vertical analysis, as we previously learned how to calculate it, you're reporting each amount, each item, as a percentage of some designated total. So for the income statement, that total that we're dividing every number by to get a percentage is net sales. And the number we're dividing every other number by to get a percentage on the balance sheet is total assets. So here again is French Connection Importers, and we're going back to their comparative income statement. And so here for 2012, if I divide sales by sales, that's 100%. If I divide the cost of goods sold by sales, that's 72.1%. If I divide gross profit by sales, that's 27.9%, all the way down to net income divided by sales is 8.6%. Then I'm going to do the same in 2011. 2011 sales divided by 2011 sales is 100%. 2011 cost of goods sold divided by 2011 sales, 73.4%. All the way down to net income divided by sales is 7.7%. Now, once we have those calculations made, then we're taking a look at how the percentage changed over time. So the cost of goods sold used to be 73.4% of sales. Now it's 72.1% of sales. And we saw that also with horizontal, that the cost of goods sold as a percentage has went up, but it went down compared to sales, how much sales went up. And so we can explain this decrease by the fact that cost of goods sold didn't go up as much as sales, didn't go up at the same rate. And we already had circled that as being something we were going to investigate. The gross profit went from 26.6 to 27.9. Primarily, that is due to this change in cost of goods sold. The operating expenses went down as a percentage of sales, and we did see that in the horizontal as well, and we were going to investigate that. How were we able to hold selling and administrative office type expenses down a little? And so our operating income, which is just gross profit minus operating expenses, went up because our gross profit went up, but our operating expenses percentage went down, so our operating income definitely went up. It's usually a good thing, but again, until you investigate it, it might not be. Okay, the other revenues, small numbers, we're not worried about that. Other expenses went from 2 to 1.5%, so they went down a little bit. Usually we're not real overly concerned about other revenue and other expenses. So unless it's something particular that's a problem or something, then we don't usually concern ourselves with either of those. Okay? And so the next one we'd probably look at is net income. Went significantly 7.7% of sales to 8.6% of sales. And so that went up significantly. So Part of it's due to the cost of goods sold not coming up as high, the operating expenses going down, etc. Help to make these numbers come up. Now, the vertical analysis is not nearly as important to us as the horizontal analysis that we had done in the previous videos. But it can help just kind of like confirm some things and whatnot. After you've done a good job with the horizontal, you can go in here and kind of see how some of those things you investigated changed the percentage for vertical. Okay, so here we're at the comparative balance sheet, and again, the total assets, you're going to divide every single number in 2012 by the 2012 total assets. So in 2012, cash was 5.7% of the total assets that we had. Whereas in 2011, we're going to divide every number by the 2011 total assets. So in 2011, cash was 4.8% of the total assets. So cash is a higher percentage of our assets. And we would ask ourselves, why is that? Management may want to look at putting some of that cash sitting in a checking account, not earning us anything. They did put a little bit into these government notes, but maybe some other short-term investments, or if we're planning on doing a big expansion sometime in the next few years, we may want to look at some even longer term. If maybe $20,000 or $15,000 in cash is enough to, cover what we need to do, then we would want to put a nice big chunk. You don't want cash to be such a high percentage of your total assets. Apple did this, and there was a lot of investors that were not happy about that, that there was all this cash, but Apple didn't believe in sending out dividends, and so the cash is just sitting there. So, you may want to take a look at that. The 4.8%, even that might be a little bit on the high side. So, unless you have that many current liabilities that you're going to need this cash for imminently, it seems like the policy is to have a little bit too much in cash. Now, our accounts receivable was 12.1% of the assets. Now it's 13.6%. That's because the accounts receivable went up, and we were already going to investigate that as part of our horizontal analysis. So hopefully that gave us an answer to that. Our inventory went down a tiny bit as a percentage. Okay. With our liabilities, we're still dividing every number by this total asset number for that year. Okay. And so we can see for notes payable, 9.1% of our total liabilities and owner's equity, which is the same as our total assets. 9.1% was notes payable, and now it's down to 2.2% because we paid off a lot of these notes. So again, we would have already investigated that back in our horizontal analysis. Also, our accounts payable went way low, and we discussed that already as well. Okay. And our dividends payable went up a tiny bit because we had a good year and we're giving more dividends out to the investors. Okay, for stockholders' equity, our common stock and PITC together went from 14.5% and 3% to 16.5% and 4.4%. This is because we issued new stock that would have come from the statement of cash flows. And so now the balances we have in these accounts are a higher percentage of our total liabilities and stockholders' equity than they were. Okay, our retained earnings went way up as a percentage because we had so much extra net income that got closed into retained earnings. We also had such a decrease in liabilities. Here's our total liabilities went from 53.4 down to 38.4. And so out of the grand total, less is liabilities. So more is going to look like it's